And Tobias, I noticed that you have a new year-end target for the S&P 500. It's 2,700. Of course, it'll be a bumpy ride to get there. How do you see us getting there, and will we make new lows before we get to 2,700?
I'm not necessarily convinced that we have to make new lows, but I do think some of this bounce back is a little bit overdone in the very near term. Clearly, there's been some good news in the form of getting fiscal stimulus, significant monetary stimulus with the if you like, heavy efforts being put in place by the Fed. About a week ago, when the market had broken on Monday last week below the 2350 kind of lows of December 2018, we noted that we thought there was about 100 points of further downside risk on the S&P 500 to 2200, from 2200 down to kind of 2100, and that we saw about 500 basis points of upside. So the risk reward was kind of, if you think about it, 1 to 5, reward was dramatically better than the risk. We've almost flipped that in a week, given how strong the rally was last week. So we've come back a very far way, but there's still, unfortunately, a fair amount of bad news that we're going to have to tolerate.
Yeah, and in the meantime, investors are looking to hide out in certain sectors. We see, for instance, the healthcare sector and certainly companies that are involved in potentially coming up with a new treatment for coronavirus really leading the way. Something else that you've been looking into is the global sales exposure of S&P 500 companies. We know the dollar has given back some of its gains last week, but is still firmer for the most part for the month of March. What surprised you the most as you looked through all those S&P 500 companies to look at their exposure to overseas markets?
So nothing was wildly surprising, other than I think for most people they don't understand that direct sales exposure for S&P 500 companies to international is about 72%. Rather, the reverse. The 72% is the domestic component, and the international component is 28%. But even that's overstated. So, for example, if you were to look at the semiconductor industry, nearly 70% of their business is sales outside the U.S., particularly into Asia-Pac, and yet those are chips that are going to a contract manufacturer that may be located in China or Taiwan or Hong Kong, et cetera, and then gets sent back to us in the form of a smartphone or a server or PC or a tablet. So those aren't actually Asian sales. They just happen to go initially to that destination before getting re-exported to us. So probably about 75% of S&P 500 revenues are coming from North America. And I think there's this tendency to believe that half of our sales are outside the U.S., and it's totally inaccurate.
Yeah, I mean, that's a great point, Tobias. So when you look at sort of just the broader economic picture here, and you look at the idea here that there are still some interdependencies here between not only whether we're talking about the end user or whether you're talking about supply chain, or really just whether you're talking about a balance where you have to have some sort of balance in the global economy for everyone to sort of benefit here. Do you have any concern here about that we may be on a path to some pretty significant imbalances between which regions of the world recover faster than the other?
So certainly the countries that are putting in and have the ability to put in more fiscal stimulus, more monetary stimulus, are on a better path than necessarily countries that don't. So if you look at certain emerging economies where they don't have that kind of financial strength, they probably struggle a little bit more. I think your point about the supply chain is really important. And that was one of the initial concerns when coronavirus broke out, that Chinese facilities would not be able to get different items to the U.S. And we do have some shipping issues that are coming here, but the bigger problem right now is our service economy, which is 70-75% of U.S. GDP, is shutting down in response to shelter-in-place, work from home, social distancing. What used to be our strength that buffered us from kind of the cyclicality we've seen elsewhere in the world actually has become our Achilles heel, as nobody can kind of avail themselves of those services. And as such, the supply chain does have impact. And one of the changes that might come out of this is the companies will try to make sure that they have some local supply chain, not just somewhere that they can't necessarily get it from unless it takes 4 to 8 weeks.
And before we let you go, Tobias, I just want to get your thoughts here on what we've been seeing in oil prices and just the commodity markets in general, but specifically with this drop that we continue to see in oil, obviously a drop that seems to be tied to things completely outside the realm of coronavirus itself, but of course exacerbated by this situation. I'm wondering, do you think that could be a drag on the U.S. economy, given our exposure to the oil market, given the bump up in shale over the past decade?
So you've kind of threw three things in there. So let me try to address them quickly. Number one, about 1.3 million workers in the U.S. work in the energy space, including petrochemicals, and yet the price decline, if you like, in gasoline for the vast majority of others offsets that to a great degree. I think there was a lot of misunderstandings even a few years ago during the shale boom, when it's like 1.3% of GDP comes from the energy sector capital spending. So it's not the driving force of our economy. It isn't good, and certain parts of the country are going to really be hit more significantly. If it's North Dakota, if it's the Permian Basin in Texas, things like that are going to be hit as a result of shale, but it isn't necessarily a disaster for the economy. What is happening is, A, the OPEC agreement failing and this kind of price war that's been started, and number two, one of the things that you kind of also have to think about with OPEC is that or oil particularly, it's being hit by both a demand shock and a supply shock.
Yeah.
The supply because of the price war, the demand because of what's happening as a result of coronavirus. For example, Americans aren't driving around the way they were doing before because they're kind of stuck at home. So we've got a lot of things going on at the same time, and it's deeply unfortunate for the industry to be hammered by these various events.